Dr. Tong and everyone, good day. This presentation is for Calmat 2011 Spring Taxation Class Final Exam. My topic is comparison of FIFO and LIFO. During this presentation, I will explain the meaning of FIFO and LIFO, followed by two illustrations. Then, I will talk about what is the difference and effect under FIFO and LIFO. After that, I will discuss when to use FIFO or LIFO. At the end, I will focus on the tax benefit, compare FIFO versus LIFO. FIFO and LIFO are different inventory valuation methods. With these two methods, the ending inventory book value might appear too high or too low compared to current market value, and net income might appear low or high. One thing that we have to keep in mind is FIFO and LIFO are cost flow assumptions, not product flow assumptions. FIFO stands for first in, first out. The cost of the goods sold will be calculated by using the cost of the inventory that was first purchased, even if the cost of inventory recently purchased are high. LIFO stands for last in, first out. Using LIFO, the cost of the inventory that was most recently purchased will be the cost of the goods sold, even if the inventory actually sold was originally purchased at a lower cost. As for our example, ABC Company has beginning inventory at $30, 6 units at $5 each. On January 1st, ABC purchased 7 units at $6 each. On 10th, sold 8 units at $10 each. We can see the cost of the good is $42. Net income is $38, and the remaining inventory is $30. On 20th, ABC Company purchased 10 units at $7 each and sold 5 units at $10. The cost of the good is $30. Net income is $20, and remaining inventory is $70. As a result, ABC Company has total $58 net income during this period of time and remains $70 in inventory. Same scenario, but this time we use LIFO instead of FIFO. ABC Company has beginning inventory at $30, 6 units at $5 each. On January 1st, ABC Company purchased 7 units at $6 each. On 10th, ABC Company sold 8 units at $10 each. The cost of the good is $47, and we can see net income is $33 and the remaining inventory is $25. On 20th, ABC Company purchased 10 units at $7 each and sold 5 units at $10 each. The cost of the good is $35. Net income is $15 and remaining inventory is $60. As a result, ABC Company has total $48 net income during this period of time and remains $60 in inventory. Now let's take a look the difference between two methods. During period of increasing costs, LIFO compared to FIFO will cause lower inventory costs on the balance sheet and higher cost of goods sold on the income statement. This means profit margin, return on asset, and return on stockholders' equity will be smaller under LIFO than FIFO. On the other hand, tax is lower. The inventory turnover ratio will be higher when LIFO is used during period of increasing costs. The reason is that the cost of the goods sold will be higher and the inventory cost will be lower under LIFO than under FIFO. Since FIFO and LIFO pertain to the flow of products cost, I believe the answer involves the rate of the change in the cost of the products. In other words, if the cost of the company's products are steady, it won't matter whether a company uses FIFO or LIFO. On the other hand, if the cost of the goods it purchased are increasing, there will be difference in profit and inventory value between FIFO and LIFO. In period of rising price, you will want LIFO. In period of declining price, you will want FIFO. The main benefit of FIFO is that it puts the most current inventory cost on your balance sheet. Therefore, give you more deduction on your income statement in time of deflation. The benefit of LIFO is it runs the most expensive current inventory cost through the income statement. Therefore, give you more deduction in time of inflation. But in some cases, it's common for a beginning company to use FIFO for reporting the value of merchandise to improve their balance sheet. As the older and cheaper goods are sold, the newer and more expensive goods remain as assets on the company's books. Having the higher value inventory and the higher profit margin on the company's financial statement might increase the chance of getting a loan. What is the tax benefit compare FIFO versus LIFO? Using FIFO, the cost of goods sold will calculate it by using the cost of the inventory that was first purchased. Since the inventory first purchased had a lower cost than the inventory last purchased, your ending inventory will be valued on the balance sheet at a higher cost. It results lower cost of the goods sold on the income statement. From the chart, we know low cost of the goods sold equal high net income and high profit margin. When earnings are higher, taxes are also higher. And when taxes are higher, after-tax earnings became lower. From tax point of view, FIFO did not have any tax advantage. On the other hand, using LIFO inventory method, your ending inventory will value at a lower cost. It means remaining inventory in your warehouse is the inventory that you first purchased. In other words, your cost of the good ending inventory equal to the cost of the beginning inventory. Since LIFO makes the inventory last purchased equal cost of goods sold, as a result, the ending inventory will have a lower value. Your current ratio will be lower since your inventory is a lower value. In addition, the profit margin ratio will be affected as well. The cost of the goods sold equal inventory last purchased equal higher cost and the lower profit margin, which is mean lower tax payable. LIFO result in lower tax earning because cost of the goods sold are higher, therefore lower tax and higher after-tax earning. Now for conclusion, it is important to understand the difference between FIFO and LIFO because there are two financial statements that are affected by the choice of LIFO or FIFO. First, cost of the goods sold in income statement. Second, valuation of inventory in balance sheet. As a result, a company can impact both its earnings and current assets simply through its choice of inventory cost accounting measures. Since we are in taxation class, tax is our major concern. LIFO gives a tax advantage because it defers paying tax on inflation. LIFO match current costs and current revenues better compared to FIFO. LIFO is the best used when prices are rising, which is in general case, because it leads to income tax saving and therefore allows the company to keep more cash in its business. And this is the end of my presentation. Thank you for viewing it.